Silver AS dramatic surge, breaking long-standing price records, has triggered a wave of curiosity and concern across the financial world. Yet what stands out, even more than price action, is the silent accumulation happening behind the scenes. Reports indicate that JPMorgan has steadily moved vast quantities of silver into its vaults, representing a notable share of global supply. If this metal is as insignificant as some commentators insist, why would one of the world's most influential institutions be securing massive physical reserves? My own interpretation is that a broader pattern may be completing, one that echoes throughout every major financial upheaval in modern history. Before this window closes, it's worth examining the sequence that seems to unfold again and again. What I've observed is that major financial breakdowns rarely occur suddenly. They follow a recognizable four-stage arc. Silver, based on numerous indicators, appears to be entering that decisive final stage right now. To understand why, we need to revisit where this began. Stage 1 is what I call the foundation period, a phase where authorities create the appearance of stability. After the volatility of the Hunt Brothers era in 1980, regulators crafted a framework designed to discourage extreme moves in silver. Instead of suppressing demand directly, they engineered a parallel paper system. Analysts estimate this paper market to be dozens of times larger than the actual physical silver available. That disparity alone hints at structural fragility. According to publicly available data, open interest in certain exchanges has reached levels more than double the physical metal stored in vaults. In other words, far more silver is promised on paper than exists for delivery. As long as confidence holds, the system functions. But confidence is a fragile foundation. Stage 2 is the expansion phase, where pressure builds quietly. In the years following the 2008 financial crisis, global central banks injected unprecedented liquidity, tens of trillions of dollars collectively. And yet, silver's price remained curiously muted. Each time demand ticked higher, large institutions reportedly countered by issuing additional paper contracts, saturating the market and preventing price escalation. Meanwhile, industrial consumption, solar technology, electric vehicles, electronics, medical devices began accelerating. Industry estimates show that more than half of all silver usage now comes from manufacturing and technology, a dramatic increase compared to earlier decades. At the same time, mining output has not kept pace. Production has trended downward for several years, creating what some analysts call a structural deficit, meaning more silver is consumed annually than is produced. The shortfall has been met only by drawing from above-ground inventories, stockpiles that are now being steadily depleted. Nations such as India and China have been absorbing large quantities, adding further strain. All this occurred while one institution, JPMorgan, reportedly accumulated hundreds of millions of ounces since 2011, positioning itself in a way unlike any other player in the modern market. They once held substantial short exposure, but according to industry observers, they eventually transitioned into one of the largest physical holders globally. By the end of Stage 2, the gap between paper silver and actual metal becomes so wide that even a modest disruption could expose the imbalance. And that is where the world seems to be heading. Stage 3 of this historical pattern is what I refer to as the fracture point, the moment when stress becomes visible and the paper framework shows signs of failing. In my view, that phase is already unfolding. Recent market behavior suggests that the divide between contractual promises and physical metal is no longer theoretical. It is actively influencing price action and liquidity. A key example occurred when a major derivatives exchange temporarily went offline due to a reported technical malfunction involving server infrastructure. The outage lasted long enough to disrupt the normal flow of trading, and during that window, silver's price skyrocketed to levels never seen before. The moment trading resumed, spreads widened dramatically, indicating that market makers were uncertain about available liquidity. That kind of volatility is not typical. It's the kind that emerges when a tightly stretched market is suddenly deprived of artificial pressure. Shortly after this event, filings revealed that a major institution shifted a large portion of its vaulted silver from the registered category, metal that can be delivered against futures, to eligible, which is essentially stored but not designated for contract settlement. This reclassification effectively reduced the pool of metal available for delivery during a period of heightened demand. While interpretations of this vary, the timing alone raises important questions about whether institutions are preparing for a squeeze or attempting to avoid fulfilling obligations during turbulent conditions. Another sign of stress came from lease rates. At one point, the cost to borrow silver surged to exceptionally high annualized levels. Lease rates rising that sharply typically indicate one thing: available physical metal is scarce, and participants are willing to pay steep premiums simply to access it temporarily. That is not a normal feature of a well-supplied market. It is a red flag. These events have occurred alongside a year where silver has nearly doubled in price, marking one of its strongest yearly performances in decades. Price strength by itself does not necessarily indicate crisis, but the context around it does. Supply deficits, vault outflows, elevated borrowing costs, sudden price spikes, and shifting inventory classifications all point toward tightening conditions. This brings us to stage 4, the eruption phase, when demand for physical metal overwhelms the paper system. Historically, this stage has produced dramatic outcomes. In 1979, two wealthy brothers recognized tightening supply and aggressively purchased physical silver and futures contracts. Prices shot upward at astonishing speed. Regulators stepped in, changed the rules, and forced the market into liquidation to halt the surge. The crash that followed destroyed their position, but it did not invalidate the underlying reality. The shortage was genuine, and the price had reflected that scarcity until intervention abruptly stopped it. That historical episode matters because it demonstrates how fragile the paper-based system becomes when too many players want real metal at the same time. The difference today is that the dominant participants aren't rogue speculators. They're institutions with influence, experience, and an understanding of how such squeezes unfold. That's what makes the current environment so concerning. All the markers of a developing imbalance are already visible. The question is no longer whether the system is straining, but how close we are to a full-scale rupture. If the third stage of this long-term pattern is defined by fractures, then the next phase, stage 4, is defined by acceleration. This is the point where underlying imbalances collide with policy decisions, market psychology, and liquidity constraints. And at this moment, all three forces appear to be converging. A critical catalyst lies just ahead, an upcoming Federal Reserve meeting. Market expectations overwhelmingly point to a rate cut. Historically, when the central bank moves toward cheaper money, the US dollar tends to weaken. A softer dollar usually pushes precious metals higher, but silver often reacts more violently than gold because it occupies a hybrid role, part monetary asset, part industrial necessity. That dual identity can transform modest policy shifts into disproportionately large price movements. Gold has already surged to historically unprecedented levels, setting new highs and drawing institutional inflows. Yet silver, despite its recent breakout, remains far from its inflation-adjusted peak. If gold continues its upward trajectory, silver tends to follow, but its moves are typically sharper and faster. That's why analysts often describe silver as gold with leverage, and why even minor deviations in supply and demand can produce outsized price volatility. Meanwhile, structural pressures continue to build. Inventories at major exchanges have been draining steadily. Registered silver, the portion available to satisfy delivery requests, has already fallen significantly compared to previous years. If that pool drops below a critical threshold, the paper market could face serious strain. Some analysts estimate that at current drawdown rates, inventories could hit a stress point within months, not years. Then there's the industrial component. Modern technologies, from EVs to AI-dependent data centers, rely on silver's conductivity and efficiency. Demand from these sectors has been climbing, even as global mining output struggles to recover from years of underinvestment. When you combine accelerating industrial consumption with tightening physical supply, the backdrop for a squeeze strengthens. Market forecasts from institutions and independent analysts vary widely, but an interesting pattern emerges. Nearly all earlier projections for silver prices in 2025 have already been exceeded. Even the conservative estimates have been overtaken by the metal's momentum. If the paper system remains intact, moderate gains might continue. But if cracks widen and more buyers insist on physical delivery, the outcome could be far more dramatic. History provides a blueprint. In both 1980 and 2011, silver's largest price surges occurred when sentiment shifted rapidly from complacency to urgency. The difference today is that the structural foundation, industrial scarcity, long-term deficits, and institutional accumulation, and a stressed futures market, is far more pronounced. Put simply, the conditions for an explosive move are not hypothetical. They're active, visible, and intensifying. The real question now is what happens when a system built on leverage, assumptions, and paper claims collides with the realities of limited physical supply. That confrontation is the essence of stage 4, and we appear to be standing at its threshold. As we stand on the edge of stage 4, the eruption stage, the signals all seem to point in one direction. The market is approaching a moment when physical reality overtakes the paper narrative. This isn't speculation, it's the logical endpoint of decades of imbalance. Since the early 1970s, when the dollar was fully detached from precious metal backing, the global financial system has relied heavily on confidence rather than tangible assets. That model can function for a long time until it encounters limits. Silver, in this context, is simply the messenger revealing those limits. Over the past several decades, the money supply has expanded relentlessly. Government deficits have grown, interest rates have been held down for extended periods, and asset prices have been propped up through intervention. Yet silver remained relatively cheap, even as its industrial relevance grew. That disconnect is part of why the current surge feels less like a speculative bubble and more like a structural repricing. an adjustment to decades of suppressed valuation. Meanwhile, premiums on physical silver are already showing signs of strain. Dealers have reported increasing delays and rising markups, even while official spot prices lag. We've seen this dynamic before, most recently during global disruptions in 2020, when physical silver briefly traded at dramatic premiums over the quoted price. But unlike 2020, the current pressure isn't tied to a temporary shock. It's tied to a long-running supply deficit paired with accelerating demand. If futures markets continue losing deliverable metal, the gap between spot and physical could widen significantly. In a stressed environment, premiums of 30-50% or more are not unrealistic. That acts the hallmark of a market where paper contracts no longer function as reliable proxies for the real asset. Once buyers lose confidence that paper can secure actual silver, the rush for physical can escalate with astonishing speed. This brings us back to the broader implication. Silver is not just a commodity story. It's a commentary on the health of a monetary system built on ever-expanding obligations. When gold reaches record levels, when silver breaks multi-decade highs, when industrial shortages collide with financial leverage, the message becomes difficult to ignore. Scarcity matters, and markets eventually price it in. If silver were to break above psychological thresholds like $75 or $100 or beyond, it would signal more than bullish enthusiasm. It would mark a shift in how investors perceive risk, value, and the credibility of synthetic markets. And unlike past episodes, the dominant holders today are not over-leveraged speculators, but well-positioned institutions that have spent years quietly accumulating metal while prices remain suppressed. History tends to rhyme. Periods of expansion are followed by correction. Complex systems eventually meet their stress points. Whether silver reaches extreme targets or simply continues its upward revaluation, the forces driving it, structural deficits, institutional accumulation, monetary expansion, and technological demand, are already in motion. The question now is not whether change is coming, but whether participants recognize it in time. Silver may be the early warning signal for a much larger economic recalibration. And once Stage 4 fully ignites, the path forward will be shaped not by paper promises, but by tangible reality.